This is Straight Up Mortgage with Madi, and today we are going to talk about what is a subordination. As a processor, you will sometimes have to deal with subordinations, the subordination process, retrieving the subordination agreement, and if you're newer, it's like, what are they talking about, right? So in order for me to help you understand what is happening with this subordination, there are a couple of things that we should go over first. We're going to go over liens and lien positions. There are two types of liens: voluntary, which would be a mortgage. A mortgage would be an example of a voluntary lien because you have a property and then you say, okay, I am going to sign papers to have a mortgage added to my property. So that's a voluntary lien. An involuntary lien is something that you didn't give someone permission to do. So you didn't ask somebody to use your home as a collateral for a specific purpose. So like an involuntary lien could be a mechanic's lien. It could be a tax lien, right? Because the IRS, if you don't pay Uncle Sam and they look and see that you have a property, your tax lien will, your taxes will then become a lien on your property. So given these examples, we can now draw the conclusion that a lien is basically some liability, something with monetary value that is placed on your property for a specific purpose. So basically, when the IRS is placing a tax lien on your property, they're doing so because they want their money. In order for you to do anything with that property, you're going to have to pay their money. Same as a mechanic's lien. As for a mortgage lien, if you don't pay your mortgage, they can have your home. So when we purchase these properties, or when we're processing, these loans and we're reviewing title is where we would receive title is where we would review any liens that are placed on a property. Lien position. Lien position just means the order in which a lien takes precedence, right? So let's just say there was a mechanic's lien and a tax lien chilling on a property. The tax lien, because it's the IRS, that would take precedence over the mechanic's lien. So the tax lien would be in first position. The mechanic's lien would be in second position. When you are getting a mortgage, the mortgage company doesn't want any parts to play in having to be in any position other than first. The mortgage company wants to know, and it's actually something it's a clause that's within your documents, that they are always going to be in first position. There can be first position, second position, third position. I'm sure it can even go past that. But for this examples, for the purpose of this example and understanding what a subordination is, we're going to stick to talking about first and second position. Like I just gave the example of the tax lien and the mechanic's lien, where the IRS's tax lien would be in first position, and then the mechanic's lien would be in the second position. So when we are completing a subordination, when we are processing a loan, what's really being said is that the mortgage company is in first position, or they're the first mortgage lender, and then there could possibly be a second mortgage lender. When we have a second mortgage on a property, it's either a home equity line of credit or a home equity loan. A home equity line of credit is a loan that acts as a line of credit, like a credit card, right? But it's like a credit card that is being backed by the equity in your property. So it's like a credit card where the line of credit is secured by the collateral, which is your home. Whereas the credit card doesn't have collateral, right? It's just open money. It's not secured to anything. And like a credit card, when you have a home equity line of credit, let's say your credit is $10,000. You can use it, pay it back, use it, pay it back. There is a draw period for a home equity line of credit, and there's also a payback period. So there's like a set amount of time that you can draw on it, and then it does come to a point where you have to pay that off. When you have a home equity loan, that is an installment loan, something that has to be paid over time. So you get the lump sum of money up front. Let's say if you get a home equity loan with the same amount, $10,000, you would have been given that money up front, and then over time, you're now paying it off. So that's a second mortgage, while also having that first primary mortgage, which, for example, you have a 360-month term or 30-year fixed mortgage. That will be the primary, and then the second mortgage will be the home equity line of credit or the home equity loan. So let's just say when your borrower purchased their house 2 years ago, they got a first and second mortgage. Maybe they went with a mortgage company that works with companies that do, they call it piggyback second mortgages, and they got a home equity loan as they were getting their first mortgage. And now, right, they want to refinance their primary mortgage. Maybe when they were purchasing their home 2 years ago, that rate was 5%, and now rates are 2.75, and they're like, you know what, I want to save some money on my first mortgage, so I want to refinance. No, I do not want to pay off my second mortgage. I'm enjoying my home equity line of credit's rate, and I'm enjoying the luxury of having this line. I have enough space within my LTV and CLTV, so I'm not going to pay that off. I do not want to pay off my second mortgage, so I'm going to have it resubordinated. And that's when, as a processor, you have to go through the subordination process, depending upon where you're working at. So let's say you are a processor and you have a first and second mortgage, and you're refinancing the first, meaning you're paying off that first mortgage, but that second mortgage is staying where it is. In order to get that done, we have to go through what is known as the subordination process. We do that by contacting the lender to be subordinated. Let's say the subordination or that second mortgage came from ABC Credit Union. So we would contact ABC Credit Union asking them for their subordination process. They would most likely either send us a link or send us some information, direct us to their subordination department, who will then forward us some sort of document, normally that'll give us the outline as to how to complete a subordination. It's normally some sort of checklist where they'll tell you to submit basically the documents that are associated with your loan, the 1003, the 1008, the borrower's income documents, asset documents, maybe AUS, basically, the loan file. And you would submit it to ABC Credit Union, and they'll look over the file, process it. If there's anything additional that they need, they'll let you know, and either you'll have it in your file or you may have to request it from your borrower. Just depends. And then they have to final approve their subordination agreement. Once that's completed, and they complete the paperwork and they send you the subordination agreement, which is a legal document. Most companies will have the processor send that subordination agreement to their legal department to review it to make sure that it's okay with the primary lender. And then at that point, that's when your file would then be sent to underwriting, and underwriting would review the subordination agreement, and we would be good to go. So when you have a subordination, or when you have to do a subordination on a file, that's the background information as to why we have to have it done. We have to solidify the new primary lender, and we have to let the second mortgagee lender, we have to let them know that we are now going to be, the new primary lender, and we have to get our documents in order to make sure that they approve us, but also that we approve them. So that's it for subordination. I hope you enjoyed this video. I hope it was helpful. Please like, comment, subscribe. Let me know, what new content that I can create for you to help your journey as a processor be one that is more smooth. I'll see you guys on the next video.